Jason Trennert.
Another week.
Chairman and CEO of Strategas Research Partners, a Baird company. And I still need to figure out why. I mean, you're staying cautious. You're staying kind of bearish.
Yeah.
You have watched 4,100 hold. I don't know why it's holding on the S&P. And here's my question to you. What don't we know that causes you to think that we could have another, I don't know, what do you think? We could do 10, 15% lower or something? Why don't we know everything? Why isn't everything already out on the table? What would be significantly worse than we already
What we have, although I'd say, let's put it this way, what we haven't seen, is a significant weakening in the labor market. And I would say there's never been a news cycle that starts when the unemployment rate is 3.5. So I would argue, almost by the very nature of a business cycle, and I think this is going to be a real business cycle, unemployment's going to have to move higher. The other thing we really haven't seen is significant or persistent weakness in earnings. So we had 1 quarter of down earnings in the fourth quarter, and it looks like in the first quarter, which is going to start in the next week or so, you're going to have a second down quarter year over year. And to me, those are two big things. The other moving part in this gets maybe a little too maybe too pie in the sky, but we have to see what Treasury yields look like when the debt ceiling is increased. You know, part of the reason why I think yields have come down is partly because the Treasury is not issuing treasuries because you've hit the debt ceiling and you're drawing down the general account. And ironically, I think once you increase the debt ceiling, there is a chance that long-term interest rates rise.
Were you expecting the move from the October lows to reach all the way back to 4,100?
No,
so you were not?
No, absolutely not. And as you know, we're like the Tina people. We were bullish for 8 years. We got bearish last year.
What are we calling it now? There are alternatives.
Tara.
I think you just need Tara. Yeah.
But
did you coin that too?
No, we didn't know.
ChatGPT coined that.
Yeah, I'm sure it did.
Okay.
I'm sure it did. But listen, we got bearish a year ago. Looked like a great call, but like as this market does, it could make you look foolish, and we felt pretty foolish for a good portion of the first quarter. But I'm kind of sticking, Joe, to the kind of the core concepts.
I saw your notes,
which is to say that, listen, it's generally speaking, if you have a tightening of Fed policy, if you have a tightening of credit standards, you have lower profits. Those things are generally don't.
I just don't understand why we don't already see more. I don't know why it's holding at 4,100.
But I mean, if the S&P is Apple and Microsoft is 13% of the weighting.
That's one reason.
They hold, and we've certainly seen that sort of bid to quote unquote safety, and I put them in quotes because who knows if they're really safety out of the banking crisis, Jason. So to the extent that tech is that tentpole for the markets, what point do you think? We need that to crack in order for the S&P 500 to crack.
Well, I think that's where all the weights are. And I think that's true as far as the indices are concerned. But I would also say for your average investor, who probably owns a lot more than just 10 stocks that were up meaningfully in the first quarter, their statements that they're getting right now are probably not as reflective as of good news as, let's say, the NASDAQ was, or even the S&P 500. So that's another moving part in this. If we're talking about the individual investor, is that probably the indices belie what they're actually seeing on their statements, because I would say that there's a clear slowdown in economic activity. And I would say whatever your odds were of a recession before Silicon Valley Bank failed, they have to be higher now. Ours were high before that happened, but it seems to me every bank in the country now is looking at its loan books. Every bank in the country is now tightening lending standards. And the Fed should keep that in mind.
So maybe multiples are too high and earnings are too high. Okay, so you get a double whammy. We're at 4,100. Are you a 3,500 guy or are you a 3,200 guy?
I'm more of like a 3,200 to 3,400 guy.
You are?
Yeah, if you use...
Well, that would be gut wrenching.
Yeah, but I mean, we're
over time, like a slow, steady, just hideous decline for the next year.
Frankly, I get a lot of questions now about the no landing scenario, where people say, "Why do we have to land at all?" And I would say,
what do you mean no landing?
Meaning, like, listen, why can't this persist? You have a shortage of labor. Why does there have to be a recession? And the answer, I think, is if you're going to have a typical business cycle where the Fed isn't going to monkey around with it, you're going to have higher inflation and higher long-term interest rates as a result. And that means, like, the no landing scenario means you land into the side of a mountain or something. Like, I would much rather have the weakness in the economy and the markets this year before more excesses get built up, because to me it's much more painful that way when it eventually comes.